The harder you try to save, the more it feels like your money is never enough. Maybe you haven't truly understood how money works. Take just 5 minutes to completely change the way you think about personal finance. 1. Understand the core difference. Saving investing analysis. Many people confuse saving with investing, thinking that keeping money in a bank account is already safe and a step toward financial growth. But in reality, saving is about preserving short-term value. It generates little to no returns and may even lose value due to inflation. Investing means using your money to create long-term growth, even though it involves risks. The right mindset. You can't achieve financial freedom through saving alone. Investing is the path that makes your money work for you. But remember, you must learn how to invest wisely. Example, you deposit 100 million VND into a bank at an annual interest rate of 5%, earning 5 million VND per year. However, with 7% inflation, the real value of your money is actually decreasing. On the other hand, if you invest that 100 million VND in high-quality stocks or in improving your own skills, you could potentially double or triple your income within a few years. 2. Accept risk, but manage it wisely. Analysis. Risk is unavoidable on any path to building wealth. A common mistake is fearing risk so much that you never take action. However, accepting risk doesn't mean gambling. You must understand, measure, control, and diversify risk. For example, by building a diversified portfolio or investing gradually in stages. The right mindset. No one gets rich without facing risks. Successful people manage risk. Unsuccessful people let risk manage them. Example, you invest in the stock of a fast-growing company. Instead of going all in, you allocate only 20% of your total assets to stocks. The rest is distributed across real estate, bond funds, and emergency cash reserves. So even if the stock price drops, you won't be heavily impacted. 3. Master your emotions. Avoid emotion-based financial decisions. Analysis. This is where many people go wrong. Investing based on rumors, trending tips, or advice from social groups. Panic selling when the market drops, or chasing highs during a market rally. Letting emotions like fear, greed, FOMO, or impatience take control. The right mindset. Finance is a game of strategic thinking and emotional control, not gambling. Great investors know how to tune out the noise and stay committed to their long-term plan. Example, you hear friends bragging about big profits from cryptocurrency. Without really understanding it, you rush in and buy at a high price. A week later, the market crashes. You panic and sell at a loss. If you had solid knowledge and a clear plan beforehand, you wouldn't have bought out of FOMO, and you wouldn't have sold out of fear. 4. Build a diversified investment portfolio analysis. Putting all your money into a single investment channel, whether it's stocks, real estate, or crypto, might bring high returns, but it also carries the risk of losing everything. That's why the strategy of not putting all your eggs in one basket always holds true. Diversification isn't just about types of assets, but also about geographic regions, investment time frames, and risk profiles, growth assets versus defensive assets. Example, you could allocate funds into long-term stocks, real estate, bond funds, and a small portion into startups or crypto, if you truly understand them. The right mindset. Think of your portfolio like a football team. You need attackers, defenders, and midfielders. Successful investing requires strategy, balance, and flexibility. Example, a young person could divide their assets like this: 30% in stocks for long-term growth, 30% in bond funds or savings accounts for safety, 20% in skill development or a small business to increase active income, 10% in gold to preserve value, 10% in cash for emergency reserves. This kind of portfolio offers both growth potential and a reasonable level of safety. 5. Take action. Now, start with simple steps analysis. Many people get stuck in the loop of learning, overthinking, worrying, delaying. But personal finance only improves when you start taking action, even with the smallest steps. Track your daily spending. Open an investment account. Read a finance book for 30 minutes a day. Self-learn about stocks, bonds, and the market. The right mindset. You don't need to be perfect to start, but you do need to start to ever get better. Big results come from small, consistent, and intentional actions. Example: start by tracking your daily expenses for 1 week. Read Rich Dad, Poor Dad, or Rich Kid, Smart Kid over the course of a month. Learn how to open a stock trading account and follow the market for a week before making any real investments. Set a goal to save 10% of your income every month. Financial knowledge won't make you rich overnight, but it will keep you from staying poor due to ignorance. Wealth is the reward for those who are willing to learn, take action, and stay patient. The difference between successful and unsuccessful people doesn't lie in where they start, but in how they think and act. Only when you think right, act right, and stay consistent long enough can you truly take control of your finances and your life. Whether you're just starting out or looking to level up your money mindset, this video is your foundation for smarter financial choices. Don't forget to like, share, and subscribe for more financial wisdom and practical tips.